Well, good morning and welcome to this week's Market Carver. It is October, the middle of. We have gotten through the 9th and 10th, two dates of March and October that always concern me. But more importantly, this is my mama's birthday week. So happy birthday, Mom. I know you are watching. For the rest of you, I hope you are getting ready for the Thirdly meetings that are coming up. We're recording them actually this week for those of you who are going to watch them virtually. We want to see all of you in person as we can. If you've not already registered for the virtual meeting, please do. We're trying to provide more and more content inside of there, and there are these compliance issues of being able to control who's able to watch and who is not. So get in there. We're going to talk a little bit about crude oil, and the moral of this story is blow, oil, blow. Or blow, wind, blow, rather. Europe is in a huge crisis. For some odd reason, the wind has simply stopped blowing. You now have oil prices the highest that we've seen in the last 7 years. And that does put a weight on the economy. As you've heard us talk about in the Market Carver before, we do need that to be above $46 to $48 for the energy complex to be profitable in terms of what they do. We don't need it to be at $82 a share. So OPEC and the team there have decided that they're going to slowly introduce more oil. Why wouldn't they? It's their number one commodity. It's just capitalism in action, and they're going to do it that way. But we really need to pray for wind in Europe. And I know that sounds hilarious, but when you look at the global economy in terms of where we are, that's really what's going on. So let's get to market valuations. Now, we're going to talk about the price-earnings ratio, and I want you to know if you were having a private conversation with Adam, he would tell you that he's far more interested in the PEG ratio, price-to-earnings growth, going out over an extended period of time than price-to-earnings. But it is important to understand this. At the end of July, so it's a little bit outdated, this is barren stuff, the price-to-earnings ratio is 34.2. In February of 2000, that was right before the peak. Remember that March 10th date I talk about? That was the tech wreck that occurred and started March 10th. The tech bubble, it was 22.2. So we are, by all definition, more overvalued right now than we were at that point in time. Earnings are much greater, but that's where that ratio comes from, is the price-to-earnings ratio. Now, we often talk about a few stocks that skew the S&P 500. You've heard us talk about that many times, where the Big Five controlled 15 to almost 20% of the value of the S&P 500. A nice thing that is taking place right now, according to Andrew and other things that are out there, is that it really is widespread. So when we're looking at this, you can see the number of companies that are actually putting stock to the market right now. So remember, when you put money into the market, when you sell your stock, you're usually doing it either because you need liquidity, you're doing it because you need, you've got an investor that's got all of their money in one stock, think Zuckerberg and Facebook, or you think the market is ripe. So companies are cashing in on the stock market. You can see in that green chart the number of companies that are offering U.S. stocks. Typically, you would see a ratio this high just of being of initial public offerings. That's not the case. Existing companies are doing it too. There have been 556 follow-up offerings on stock sales by companies of existing shareholders among U.S. companies this year. That's the most since 1996, according to Deal Logic. They've raised a total of $133 billion. And the scary part to me is they're putting it at the market. They're not trying to say, hey, we'll sell this if the stock goes up another 15%. They're essentially saying the price today is good for them. That all denotes volatility. Now, I showed you this chart last week. This is a very, very, very important chart. And when you talk about 1995, folks, it wasn't that long ago. I showed you this chart last week, and I got a question, good question. How does it impact our investment strategy? Well, it's never really impacted the Financial Enhancement Group. From the time we started, I looked at this and said, you know, we need to have money that's coming out of long-term capital gains, money that's coming out of dividends, and money that's coming out of interest. And you needed to have a cycle that allowed all of that to be able to exist. You needed and this was back in 1997 when we started the firm, you really needed to have an entire menu, if you will, of what was going on. Well, that wasn't the attitude. The attitude was when you got ready to retire, you would sell all of your stock and go to bonds. Well, we all know you can't do that at 1.2%. And that's really what this chart was impacting. So it's showing in 1995, you could have done it with 100% bonds. By the time you get to 2005, you needed another mixture. And the key thing down at the bottom is that standard deviation. That's volatility, or the amount of risk that you had to take to be able to have the same expected return over an extended period of time. And by 2015, that volatility rate had tripled. It has gone nothing. It has done nothing to change. And in fact, it's probably worse. It doesn't change our investment strategy because that's not how Adam and I have always looked at how that income needs to be produced. And your planning team has looked at it, and it's because we've always had that tax-sensitive nature from the very beginning. Now, bonds are under pressure, and this is one of those things that you need to keep in mind. When that line is going up, that means yield is going higher. Think about my teeter-totter, right? When the yield's going higher, the value of existing bonds are beginning to fall. Barclays Aggregate Bond Index, that's what we watch to measure pretty much the entire complex of bonds, if you will, is now down 2% for the year. That's right. If you're a bond investor because you're scared of the stock market, you're now negative 2% year to date. That's why that last chart was so important when it comes to that strategy. We really have to have assets in different places that can be able to protect us, knowing that they're not all going to be home runs. In fact, that's not our job on anything. What we want to try to do is get on base and score runs. Hey, I hope to see you at the Thirdly, either virtually or online, one way or in person, one way or the other. Don't forget, if you want more, you can listen to the radio program, 6 to 7 a.m. on WIBC or anywhere you listen to podcasts. We've got a great guy coming on this week, one of my friends that's in the Slot Network, Bill Harris. We're going to be talking about what happens with your spouse and saving your spouse's IRA when you happen to lose one. In his case, it's primarily dealing with widows. It is true, men die 70% of the time first before the female. But either way, this information is important and critical. I hope you can join us and listen to the show. Have a great week. We'll see you again soon.